Welcome, everybody. Thank you for joining us today on our first after pandemic presentation on tax mitigation. Today we have two great topics we're going to speak about. One is going to be the restrictive property trust and how we've utilized this program over the last 22 years and how it's building up more and more steam as we go forward. I've been working with Ken Crabb for many years on this program. I personally just got out of my RPT and I funded mine for 10 years and I'm out. And it's ironic how it started is basically the way it ended, exactly how we presented it. As we go forward and we go back to normal and our normal work life, we're starting to see after yesterday was a big day. I can't tell you how many phone calls I got on people literally losing their minds because they had to pay an abundance amount of taxes. So with that, I'm going to bring up Ken Crabb, who will talk to you about the restricted property trust.
All right. Thanks, brother. All right. Good morning. I'm thrilled to be here in New York City today with Hoteling Insurance Services. I'm going to talk about the restricted property trust. I'm going to blow through some of the old historical stuff because I have about 25 minutes. So I'm going to cover where the plan is today. I'll go through some of the litigation that we've survived and one case that's ongoing in some more detail. All right, first things first though, the restricted property trust is fully selective. What that means is when we're presenting this to business owners or now we're starting to present to large public companies, we can be fully discriminatory. If I go in and I see a business owner, we can ignore the receptionist, we can ignore, frankly, even other partners. So if there are 5 or 6 owners and only 2 of the owners would like to do it, we can set it up that way. So that's a huge advantage for business owners. Number 2 there, these are tax deductible contributions. That is probably the number one reason we sell the restricted property trust, but honestly, what I say to clients is we use the tax deduction to trick clients into doing the planning they should be doing anyway. And I've got some experience with that we'll get into. It is also asset protected. This is fully asset protected from federal litigation in all 50 states because it's a 402B trust or an employee benefit trust. And it's a fixed rate of return. Like what Bobby just said is with whole life insurance, it's great. It's such a highly predictable asset. Right now, I've been doing this for 22 years. My whole life in-force ledgers are running over 99% accurate to as originally illustrated. That is super powerful when people are looking at their 401ks or their pension plans, especially today, to come back and say, okay, here's what I showed you 7 years ago. Here's where we are today. It's the same thing, you move on. And this is going to have a death benefit, which is what I mean by the estate and business protection. All right, so the agenda, I'm going to cover man construction. That's a case that we won on March 3rd of this year. We're going to really roll through the welfare benefit plans because that's not as important now, especially with the man construction case. I'll go into some of the mistakes and the reason why the restricted property trust works, and then we'll actually show you guys a sample presentation. All right, so first, on March 3rd, 2022, I was on the 11th fairway at Trump National Charlotte when my attorney called, and we had the 6th Circuit Court of Appeals unanimously threw out for the first time in the history of the United States, they vacated a notice 2007-83. What that meant for me, having done this, and with Bobby, I called Bobby, obviously, he was very excited, that removed our liability to 0. There's not a potential for your client to ever have to pay a penalty when you do the restricted property trust because it cannot be considered a potentially abusive tax shelter. That was huge. Frankly, again, personally, my liability was very wrapped up in that. If I would have lost man construction, I don't know how many tens of millions of dollars of potential promoter penalties I was going to be facing, certainly more money than I had. So that was a really great day. We do have another case. We have McGowan versus Commissioner. The discovery ended on that September 30th. Our motion for summary judgment gets filed this month, the 31st. Rebuttals are due November 14th, and we'll have a ruling on that anytime. I will tell you that one, the McGowan case is on the specific tax reporting. When we win that, the restricted property trust will be akin to a 401k. It's not going to be really considered fancy advanced tax planning because we're going to have federal court cases that support our position. I will tell you that I was always more nervous about the man construction case because that was more legal nuance. We were arguing over what does the word purported mean? What does the word substantial mean? Whereas with McGowan, it's on the tax reporting. It's very black and white and straightforward. I've always been 100% confident in that ruling, and we will have it first quarter next year. All right, so how many here in the room and around have heard of 419 plans? All right, so 419s, and it's been a long time. They were put into the Internal Revenue Code in 1928. I'm sorry, welfare benefits were in the Internal Revenue Code in 1928, and people were buying yachts and ski chalets and taking deductions for what was called a welfare benefit plan. The IRS complained about it to Congress. Congress enacted these two code sections that are very much maligned. I don't think any of these should have been called a 419 plan because 419 is a code section of limitation. It is not a code section of deduction. And what they did is they limited it and they said, okay, you can take a deduction, but it can't be for a jet or a yacht or a ski chalet. You can take a deduction for a life insurance policy, health insurance policy, or disability policy. So death, disease, or disability. And the deduction must not exceed the current year's qualified cost. I put qualified cost in quotes because Congress literally made up that term. Nobody knew what a qualified cost was. That is why you saw a lot of insurance advisors and accountants and tax attorneys working with these accepted plans. 419 Cap A is a code section of exception. So if you had a union, you didn't have to know what a qualified cost was. The NFL actually has a 419 AF5 plan. By far the most popular plan was the 419 AF6. This did over $2 billion of life insurance premium in the tax year 2000. And the IRS rightfully came after this plan. That was the first one they attacked. People were putting $1 million into an insurance policy, taking 100% deduction and borrowing the money back out tax-free. They were incredibly abusive. When the IRS attacked those accepted plans, that's when single employer plans became more predominant in the marketplace. Now, a little bit of my history. I was working inside of a billionaire family office in Cleveland, Ohio, and we were developing, this client was desperate for tax deductions, and they wanted tax-deductible life insurance. I went out into the marketplace in 1999, and I found 47 plans that purported to offer tax deductions for buying life insurance. Unfortunately, my client's two law firms said no 47 separate times. So we went to work on the restricted property trust, and the reason I just survived all that federal litigation, I've had my emails subpoenaed by the Department of Justice, I've been deposed by the Department of Justice, I've had my emails subpoenaed by the National Office of Chief Counsel, and I'm still here, is because when we originally designed the restricted property trust, we designed it to defend it, not to market it. We weren't saying, hey, what can we sell to a bunch of people? We were saying, what works? What's actually going to be legal? And this is where you set up a separate fund or trust. It's attached to just one entity. So if you take frankly, a company like Bobby's, Bobby has multiple entities. We're going to attach it. I'm going to ignore every other entity he's got, and he's going to choose the granting entity to set up this plan. There are tax-deductible contributions, but now for the first time, what are these limits that are really there in 419? So these were just some of the mistakes, and I'll go through these pretty quickly. If you guys are familiar with life insurance of any iteration, universal life is essentially built on annual renewable term insurance. So if you're putting $100,000 in, your cost of insurance is probably, depending on your age, between $1,000 and $5,000, right? It's going to be pretty cheap. In whole life insurance, we have something called a contract premium. So if you're putting $100,000 in and you have a base premium of $70,000, you have to pay the $70,000 or the policy lapses and goes to a reduced paid up policy. Well, people here were saying, they were telling the IRS, hey, we just put $100,000 or $1 million into a universal life plan, and that was our cost of insurance. It wasn't even close to their cost of insurance. It was 98% not accurate. All right, big mistake number two, especially pre-COVID, I would speak in a lot of hotel ballrooms where CPAs are trying to get their continuing education credits. And I would sit there and I'd listen to the other speakers. If I heard a speaker talk about something you get a current deduction for an appreciating asset that you get tax-free, that's when I'd walk out into the lobby and check my email. Here, people were literally writing a check to the trust. They were turning around the next day and borrowing it out. They demonstrated full control of the policy. They had full control of the cash value. What the IRS did there is they said, okay, that may be deductible as a 162 business expense, but it's taxable to you as W-2 income. All right, this is probably the biggest misunderstanding in the restricted property trust. Contributions did not have compensatory intent. Here's what I mean by that. One of the cases that I consulted on, this was not a restricted property trust case. This was in 2009. We had a business owner that was uninsurable. So the insurance agent and the CPA put $1 million of premium into a welfare benefit plan on his wife. That was about $47 million of death benefit in her case. She was younger and healthier. And they were saying that, and she was listed on the payroll as an office manager making $30,000 a year. In what universe would that be reasonable to say this business needs $47 million if she goes down? It has to make sense. I think a lot of people just lose their minds when they're doing tax planning and they forget you have to have everything be reasonable. Bobby and I ran into this early on in in our partnership in 2015, he had a case that we had a pro athlete who's going to put $1 million in. Problem with pro athletes is they're young and healthy. Otherwise, they would not be professional athletes. So this was $100 and some million of death benefit at this kid's age. And that would have left me in the position defending that audit saying, it's reasonable to assume his mom needs $120 million to continue this endorsement company if he dies. And I was not willing to put my 100% track record on the line for that. I'm going to stop real quickly. Does that make sense? Because that's really, really important. And I'll give you one more example. If I have a 65-year-old smoker, I can probably put a lot of premium in there. If I have a young, successful 27-year-old female triathlete, the death benefit gets big really, really quickly based on their age and health and all that kind of stuff. So it has to make what I'm saying here is it's going to be for buy, sell, or key person. Those are the only two potential uses because the restricted property trust has to have a reasonable business purpose, not a personal purpose. Now, I understand for owners of businesses, those overlap dramatically, which is what we're doing with buy, sell, and key person. And then finally, contributions did have compensatory intent. 99% of the cases in America, if you have a small business owner that's getting a death benefit, you can argue there's a business purpose for it, right? Continuity, key person, that's pretty easy to argue. But the IRS came in and rightfully said, this is really deferred compensation. And in all of 409 Cap A, which governs deferred compensation, I'll summarize that for you and save you time from reading it tonight online. If it's deductible to the corporation today, it's 100% taxable to the executive. If the corporation doesn't take a deduction for it, the corporation pays corporate tax on it at that moment. So there's no tax deduction that ever happens with deferred compensation. All right, and then the biggest mistake at all, which I just alluded to, tax avoidance is never legal. This is going to be a mechanism for tax deferral, not tax avoidance. So let's get into the restricted property trust. First, this is a mechanism, as I just said, a mechanism for tax deferral, not tax avoidance. The premium deducted must be the amount of premium required to fund the current contract. Everybody always asks me, do you have to use whole life? Do you have to use whole life? And I will tell you this, when we were developing this back in the fall of 1999, that's when variable universal life was just getting really popular. I was 29 years old, 23 years ago, and I wanted VUL. I wanted to figure that out. We couldn't figure it out. I am so glad that my last 22 years with the restricted property trust has been whole life for the reasons I just said to you guys. It's really boring, and boring is really cool when the markets are volatile, right? So we're always using whole life. I'm going to skip the two sub-trust. Contribution must be compensatory. I covered that. How many of you are familiar with Section 83 property? Anybody? I know Bobby is. You don't have to raise your hand. Most of the time when we hear about restricted property, over 90% of the time in the United States, we're referring to stock options. But I'm going to use a different example. Let's say I go to work for Bobby out at his Long Island office, and there's another little building across the street that's worth $100,000, and Bobby says, hey, Ken, you really seem like a nice guy. I think this is going to work out. If you work for me for 5 years, I will give you that other building. If those circumstances are true, that gives me the right to say, wow, I love working for Bobby and that building's awesome. I'm going to pay tax on the fair market value of that building today, even though I'm not guaranteed to get it in the future. So if Bobby fires me 2 years later, or I go take another job 4 years later, I'm not going to get that building and I'm not going to get my tax money back. People say, well, why would anybody do that? Here's why. If I work for him for 5 years and a shopping mall goes up across the street, so my little building is now worth $1 million, when he hands me title to that building, I don't have to pay taxes on it. It almost worked like a Roth IRA until such a time as I would sell it or realize it, then it would be taxed as a long-term capital gain, not ordinary income. How do we do with restricted property? Seeing some heads nod. You guys got that? That's a really important aspect of this plan. And then finally, number 6 there, the cash value of this policy will be taxed, less the basis that we've established. And I'm going to go through how that basis gets established on the next slide. Let's just jump right to it. So here you guys see on the slide the numbers. I have $100,000 of total premium going in. $70,000 of that premium is what's considered the contract or the base premium. $30,000 is an overfunded premium. And every insurance company has different names for what they call this stuff. But in this case, it's a paid-up addition rider. And if you go ahead and look, you see the first year cash value. It's $28,445. Here's what's happened in year 1 on that tax return. The corporation has taken a deduction for $100,000. The business owner has put $30,000 as an 83B election on their personal tax return. So we've effectively lowered their income by 70 cents on the dollar. If they could get to this policy after the first year, which they can't, but if they could, they would get a 1099-R that says fair market value $28,000, taxable portion 0. And I didn't cheat the IRS a nickel. They've already paid tax on $30,000. And that $70,000 in no way, shape, or form contributed to the fair market value of this asset. And in the second year, that's still true. I've got $64,000. Well, now I would have been entitled to $60,000. I've made two 83B elections of $30,000 each. I'm entitled to the growth attributable to those, probably about $64,000. Even in year two, although I've deducted $200,000 corporately, I've not picked up $140,000 of current tax. There would still be about zero taxes due if you could get to this after the second year. Now, that's not going to be true from year three and beyond. That $70,000 will start contributing to the cash value very quickly. But what you're seeing here is we're giving the IRS the most expensive part of the premium, so they're covering all of the insurance costs. So although this is just a mechanism for deferral, there's some very good tax leveraging in here that helps our math. All right, so the advantages we've talked about. Number one disadvantage, it's not even close. When we were sitting around, again, we were working with a billionaire family. We knew we couldn't have that family, we couldn't say the owner was going to fire himself. And at that time in the United States, none of us had ever seen a risk of forfeiture for someone who owned and controlled their own employment. So the most novel part of the restricted property trust is we determined that if we had a third-party independent institutional trustee, we put a 501c3 charity on notice, and we said if this business doesn't fund this for any reason for the next 5 years, our third-party independent institutional trustee will forfeit this policy for its cash value and give it to charity. And at the time, we did not let my client use their private foundation. They had one. I can't give you guys a good tax reason for that. I just didn't like the optics of it going to his private foundation, so we used a donor advised fund, which was fine. But that 5-year minimum commitment, this is the number one reason people don't do it. I also think that's pretty silly. I'll get on the phone with a doctor and say, hey, I wouldn't commit to more than 4 years of your non-qualified assets. So if he's looking at putting in $100,000, he or she, if they don't have $400,000 lying around, that's a pretty big risk. I will tell you very quickly, the IRS has never understood this risk of forfeiture. They're starting to understand it now. But I had the fastest audit of my career. And real quickly, anytime, and Bobby knows this, which is why we're still friends, if this is ever challenged anywhere in the United States, I come in at no cost with my law firms and I defend that transaction. I don't do that because I'm friendly or charitable or benevolent. I do that because I'm greedy, because that keeps my brand very valuable, right? And that's why I keep my track record at 100%. It's worth a lot of money to me. But I had an audit of a dentist. We had a phone conference the last week of March or the first week of April 2020, and the field agent said, well, this is silly. The dentist owns 100% of this practice. He can just choose to pay the premium. I said, gosh, that's awesome. Hey, could you call the governor for the state of Ohio and let my client open back up his office? Because right now he's not allowed to go into his dental practice because of COVID. So you're under the impression that business owners operate in some vacuum that outside factors can't. That was the fastest audit of my career because of COVID, one of the silver linings was the IRS understood, and we have hotel owners and restaurant owners. I had 3 forfeitures the summer of 2020 because of COVID, so that part was unfortunate, but it helped the IRS understand that business owners don't control everything, right? There are outside forces that affect a small business owner. The contributions have low flexibility. The cash is not accessible while participating, so we use this a lot in conjunction with premium finance planning. But this part is not ever put up as collateral, because if they could post the cash value as collateral, that would show an incident of ownership. The only thing the insured has a right to while they're in the restricted property trust is a death benefit. And there's only one way to get that back out. I don't get any volunteers for that. You have to qualify for coverage. I will tell you the worst day of my career, I was looking at a case for a fine artist who makes over $100 million a year. And what's the business purpose there? Literally unlimited. It would have been like writing a restricted property trust on Prince. I could do whatever I wanted, right? The business purpose is unlimited. We sent him in to get underwritten, and he peed heroin. If you guys are not familiar with the life expectancy for heroin users in the United States, that will get you disqualified from getting a new policy very quickly. It's about 19 months, and that was pre-fentanyl, so it's probably now like 11 weeks or something. So you do have to qualify for coverage because we are going to be using life insurance as a funding vehicle. I'm going to jump right to my spreadsheet. Oh, good. I've got like 7 minutes. All right, can I blow that up at all? A little bit, Jeremy? If you guys can see it, we'll get you copies of these slides. So if you want to go back and review it, you can get copies. But here, this is the only page, and I stole this from Bobby. Bobby's like, hey, you got to figure out how to present this on one page. And I used to have a spreadsheet that was 4 pages wide and all kinds of crazy stuff, and he would yell at me all the time. So we really have it down to one page. This is the only thing. When I get on the phone with a client, I say, hi, my name's Ken Crabb. I give them some of that 22-year history. And I say, let's get 3 things clear first. What happens if this gets challenged? I've taken your tax risk to 0. That's step 1. Step 2, our 5-year risk of forfeiture is not a wink and a nod. It's real. I've had 4 death claims and 19 forfeitures. That was bad optics for the IRS when they said our risk of forfeiture wasn't real. And then number 3, we have to have a business purpose for the death benefit that's clearly defined. In this case, we have a little over $3 million in death benefit on a 50-year-old. For me, that means his W-2 needs to be at least $300,000, or his total combination of W-2 and K-1 needs to be about $600,000, 5 times. I'll do that in death benefit. Once we have those things straightened out, and although I'm showing a 10-year funding, it's really 2 separate 5-year commitments, because before that 5th premium is due, the client's going to have a right to amend and extend the policy for another 5 years. And frankly, they can do that for years 11 through 15 if they would like. So we can extend it even more. If I showed this at years 11 through 15, it would look like science fiction, because whole life is really pretty, really pretty, frankly, years 6 through 15, I think. But once they understand all that, what I'm trying to communicate on this spreadsheet is how much money do you need to put $100,000 into something after taxes? Well, you need to make $200,000 of pre-tax equivalent. You pay your taxes here in the great city of New York, and you have about $100,000 left over. One quick side note, and Bobby did want me to mention this. I don't know if you guys have seen the Social Security donut legislation that is in the Senate right now that has very strong bipartisan support, irrespective of what happens 3 weeks from now. It's pretty likely that Social Security will kick in again after $400,000. That is terrifying for small business owners. Our current tax rate, top marginal, is 37%. The 6.2 and the 6.2 for a small business owner is 12.4. That takes your effective top marginal tax rate without state and local and FICA to 49.4%. If you're in California, you're going to be mid-60s. Mid-60s. Here, you'll be over 60% in the city for sure. You got 8 state and 3.875 local, I think, unless that's changed. And I don't think the tax rate's going down here anytime soon. So that is terrifying. Here, I'm using an effective top marginal rate of 50%. And so what I'm saying on this spreadsheet is I'm glad I know the numbers in my head, because I can't read that at all. But the $100,000 goes in. In my case, because I've lowered your taxable income by $70,000, I need an extra $30,000 of income, pre-tax equivalent. I need $130,000 of gross income to get $100,000 into my plan. So I say to the client, look, if you just want to take that $130,000 home, you get to keep $65,000 there on the right side of the screen. You get to keep $65,000. What do you have to earn if your local banker calls you and says, hey, I've got a CD paying 8% fixed for 35 years? Okay, what does that look like? Because you don't get to use $100,000. If you're looking at an indexed universal life illustration, you don't get to use $100,000, you get to use $65,000. And then what does it look like? And in this case, you can see, and I'm gonna have to get really close here, I pulled out $1.9 million versus $1.3 million if the client was making 8% in a CD for 35 years. So not only did we outperform that, we actually crushed it and gave the client a free death benefit. So when I show this to clients, I say, think of your asset allocation pie chart. What slice of that would you like to commit to something that's achieving an outperforming an 8% rate of return with a free death benefit? One other thing, and Bobby and I have talked about this a lot, if you look at cash balance pension plans, the cash balance pension plan will be ahead of our cash value in year 11, to be sure. But in order to get that income out, you have to double it, right? So if you want to put $70,000, $80,000 in your pocket, you have to pull out $150,000 out of your pension plan. So what usually happens when we illustrate this against a qualified plan is we end up showing that somewhere around 83 or 84, the client's going to have more cash value left in their whole life policy, and they had a death benefit that was always higher than the qualified plan. And I had a client in Chicago, a big scary guy, owned a flooring company. He goes, well, that's stupid. I got to live till I'm 83 years old before this becomes a better idea. And I went, oh, you're right. You could die first. I was glad there was a big table in between us because he was like 6'5", 280. I said, oh, you're right. You could die first. Well, if you die, your family's going to get that death benefit tax-free, and that's way higher than your qualified plan account value. So I win if you die. I win if you live. If you make it to 90, I still outperformed it. That's the only thing I walk clients through on the spreadsheet. Let me get into one other thing here. This form is something that I really get back incorrectly very often. I have advisors. I will just tell you, when I'm showing this to clients, I like to use samples Because if I have a 53-year-old client, I'm going to intentionally grab like a 55-year-old, because if they're looking at that spreadsheet and they think it's their numbers, it's harder to understand it, right? But if I come up there and say, hey, this person's 2 years older, this is just a sample, do you understand the concept? It helps the client understand the concept. Otherwise, the client's going to look at that and go, hey, instead of $90,000 for 20 years, can I get $100,000 for 15? And that's not helping them understand the restricted property trust at all. And I'm going to go ahead and I'm going to open it up for Q&A as quickly as I can. But I just want to hit the one more highlight. Where we've had a tremendous amount of success, especially down in Houston with Gina's husband, Dan, are large medical groups. Because doctors can't agree on anything. They can't agree on what kind of toppings to put on a pizza, let alone a complicated employee benefit strategy. Well, here we'll have 16 doctors there, and only 3 doctors the first year want to do it. Okay. That's great. And that's one thing they cannot do with their cash balance pension plan. That's one thing they cannot do. So large medical groups. The other thing, now that we've won the Mann construction case, we're looking at large public companies, because public companies can't even explore a strategy that is a potentially abusive tax shelter. Well, now that risk is 0. This can never be considered a potentially abusive tax shelter. So now we're having public companies come to us and say, we really like this as an alternative to our deferred compensation plan. Right? Because the current deferred compensation plan, the exec's eating 100% of it, or the corporation's eating 100% of it. In the restricted property trust, think about the tax efficiency of the corporation enjoying a 100% deduction today, and the executive only picking up 30% as income. So that's pretty powerful, and I think that's really why this market, especially when we finish the McGowan case, we'll be doing, like I said to you guys earlier, it's just going to be a plain vanilla 401k type thing, as long as clients understand the 5-year risk of forfeiture is very real. For me personally, I put about half of what I could put into my restricted property trust because I'm married, I've got 3 daughters, by January I'll have 2 of my girls in college, and I didn't want to be on the hook for twice the number that I'm on the hook for in my restricted property trust. So I intentionally lowered it. My favorite phone calls with clients is when they call me and they're mad at me because I scared them with the 5-year risk. And so instead of putting in $200,000, they put in $100, and they wish they did more. They're calling me to yell at me, and I'm like, that just means you're happy. I'm okay with this. You might be angry. I'm super happy. Go take a trip to Italy or go do something fun. What I can't have happen is that same client calling me 3 years later going, I wish I did 100 instead of 200. Now that's a bad phone call, right? I can't fix that. So I much prefer people dip their foot in the pool with a restricted property trust. Yeah, yes. So when you commit to this, if you're putting $100,000 a year in your trust, you have to do that for 5 years. So if you go bankrupt, whatever, you could make a capital contribution to your company if you had to, but you have to fund that. If you don't fund it, our trustee is going to surrender the policy for its cash value and give it to your favorite charity. Yeah, and so that is, I've had that happen. I've had that happen 19 times. It's never fun, but the clients, we communicate that so clearly. I joke, I'm like an Old Testament prophet, right? I'm going to give you all the bad news up front. But the 5-year risk of forfeiture, we typically illustrate 10 years because 90+%, even COVID, we were at about 96, 97%. But even after COVID, I think the end of 2020, we had some people that just were unsure. I think we were just under 90% of people extending. But last year, we were up again over 90%. So 9 out of 10 of our clients amend and extend for that second 5 years, primarily because, and this is another question that comes up frequently, well, how about I just take this policy and start a new one? Well, the first 2 years of whole life, there are a lot of policy loads, right? Years 6 through 10, your cash value grows much more quickly on those contributions than they do in years 1 through 5. So mathematically, as much as it's great for a commission sales guy to keep putting new policies in there, it's not the best thing for the client, mathematically. Any other, and Gene, are you getting, yes?
So the taxes, you said that in essence you pay tax on 30% of it, but in the illustration you're showing taxes in year 11.
So when you vest, so he said, you're paying taxes on 30%. So the question then becomes, on that $700,000 I deferred, how much of that contributed to the cash value of that asset when we roll out? And that's what your client will get a 1099-R for. And it's not going to be $700,000 because the first $140,000 didn't even make it in there, right? So it's usually about $500,000 of that is taxable as ordinary income on vesting. But we're using we can do a paid-up addition withdrawal or even a loan from the policy. So we get a tax-free loan to go ahead and pay that, which is a nice, call it a ground rule double on your cash flow. if I answered that. Yes, in the back.
Hey, are there, in your experience, are there certain types of businesses that you have the most success with this program for?
It really used to be medical, but that's primarily because I got my start in Ohio and my cousins had a large medical malpractice insurance firm. So I was going out to doctors. It is now all over the place. It is, I'd say it to you this way, 73, 74 or younger. And that's someone who's going to die with their boots on, which happens with a lot of business owners. You know, their kids are running it and they live in Palm Beach. Minimum income $600,000. If they're not showing $600,000 in total, they're not in the top marginal bracket. So I'm going to ignore them. And long-term time frame and has decent liquidity. The plastic surgeons in South Beach scare Bobby and I because they make $3.5 million a year and they have $11 in their checking account. And I have some of those types of guys in my neighborhood in Charlotte when COVID shut down some plastic surgeons and they were panicked. And I know these guys make like $2-3 million a year, but they couldn't go 1 month without income. That is not an ideal RPT client because that 5-year risk of forfeiture should scare them. Like, stop buying Ferraris. But anyway, yes, Bobby.
Ken, go over how we also use this program to do college funding. Say we have a kid that's going to go to school in 7 years or 8 years.
Yep. So, and we did this precisely for a client with the hoteling group. He knew he had twins going to college in 7 years. We did a 7-year RPT. He's going to vest in that restricted property trust, pull the money out. He'll have some tax on it, but that cash value is funding his twins' college. I also did that originally. I did a case in 2003 for a guy that had triplets. He was an ear, nose, and throat doctor in Steubenville, Ohio, and his triplets just finished their senior year last year. He did 10 years in his restricted property trust, and he figured if I die before they get to college, this death benefit will help pay for it. And God forbid I live 10 years and they get ready to go to college. And he actually funded his for 15. He was my first client to go 15 years. He funded his for 15. He got it when his triplets were 3. And 3 kids in college all at the same time. I don't care how much money you make, that's a number, right? And we gave him a huge pile of cash and he paid for all of his kids' college. So that was great planning. Yes?
Actually, short question and a maybe longer question. Does the death benefit vary depending on the individual?
Very much so, yeah. So age and health and all that stuff, that same $100,000 on you will buy you a lot more death benefit than it would a 65-year-old smoker.
Okay. And then if you can go back to the chart, I'm just trying to understand, are the two universes supposed to be equivalent? And if they are, it's not clear to me why they are.
What was the question again?
Like, are the two universes supposed to be equivalent in terms of the amount of income?
It's equivalent in terms of the gross income necessary to get 100 into the RPT versus what you could take home and put in your checking account. So the pre-tax equivalent of 130 is the same for both plans. But if you don't put it in the RPT, that leaves you 65 to work with. Well, and even look at it this way. This may be a simpler way. If I lowered your taxable income by $70,000, that saves you $35,000 in taxes. That's the difference between 100 and 65.
Okay.
If that makes sense.
I have another.
Okay.
Does this live in the expense section similar to where the cash balance plan would live?
No, but great question. It's going to come out as officer's compensation for the 30%, and it's going to be an employee benefit for the 70%. Depending on if it's an S corp, I think that's line 18. I know the officer's comp is line 7. But yeah, and even in a partnership, it's going to come out as a guaranteed payment. Really glad you asked that question. We can do an S corp, a C corp, or a partnership, or an LLC that files as any one of those. Single member LLCs are disregarded entities. They have no authority to establish an employee benefit trust. So I need an S corp, C corp, or partnership, and then it will be deducted as partly officer's compensation or guaranteed payment, and then partly as employee benefit expense. And the employee benefit portion is the part that does not flow through to the 1040.
Right. So the 30% would flow through to income that the owner takes.
Correct.
The 70% goes into as an expense, as a business expense, because it's an employee benefit.
Correct.
Okay, great.
Yep. That is right. And by the way, we deliver a 7-page memorandum every January to every single client in the United States. And that's a little CYA move for me in case the CPA doesn't account for it correctly. We give them a memorandum on how to account for it correctly every year.
Do we have any additional questions on for anyone online? If you have any
Crushed it on my
questions, please
time.
type them in.
One more up front.
So a lot of these companies don't mine specifically doesn't pay a lot in a W-2 to the owner, how does one account for the amount that they can put in if they're not paying themselves a W-2?
Another great question. I'll go. I give more value to W-2. I'll go 10 times W-2, but I'll go 5 times a combination of W-2 and K-1. So if they're taking a $100,000 W-2 and they have $1 million K-1, I'll do $5.5 million of death benefit there.
Got it.
And those are rough numbers. One last thing. It is. I'm presenting that very scientifically. There is some art to it. I did a case for an electrical contractor here in New York City. My office. My operations director called me and said, "Boss, you made a mistake. You did $18 million of life insurance on a guy that had an $86,000 W-2 and his K-1 was negative." I said, "Yeah, but the gross revenues were $97 million and if cost of goods sold were $78 million. If he dies, his wife needs $6.5 million a month nut just to keep the doors open. I'll go ahead and defend that in spite of the income, right? Just based on other things on the tax return." So it's not always cut and dry. There is some art to it there, but I would easily defend that $18 million in that situation. Yes?
Do you see this as a way to retain talent?
Absolutely. Yeah, especially now. And we've done key executives for sure in small businesses. We just had not been in the public market space until post-man construction. Now that it can't be considered a potentially abusive tax shelter and there's no potential for penalties, I actually said to the CEO of a large public company, and they are going to wait for McGowan to do it. It's 183 insureds. It's a huge case. And I told him, go ahead and wait. I said, but just so you know, my plan is what you're doing now if I lose. Because they had a 162 bonus plan that the exec was picking up 100% in tax. I'm like, my worst case scenario is what you're doing now.
If the employer goes out of business in the next 5 years, say,
Yeah.
but the owner has other companies, is there any way to?
You can
to
salvage
move
it. You
this?
could do a statutory merger because that will allow you to extend all existing employee benefits
Okay.
via a statutory merger. Yeah. Yeah. All right. I know I'm on my time deadline.